If you work from home and you've heard about that new $1,000 tax deduction starting in 2026, stop before you claim it. Because if you take the new $1,000 instant deduction and then also claim your usual working from home running costs on top, the ATO has a name for that. It's called double dipping, and it's one of the fastest ways to trigger an audit and have hundreds of dollars in tax benefits clawed straight back. From the 2026-27 income year, about 6.2 million workers, roughly 42% of taxpayers, can claim an automatic $1,000 work-related deduction with no receipts. Federal Budget 2025. But here's the catch, nobody's repeating loudly enough. You cannot take that $1,000 and then itemize the same expenses again. Today we'll make 3 moves. Pick one method, run the maths, and keep records that survive a review. The number to burn into your memory is $1,000. That's the new instant work-related deduction from 2026-27, offsetting your employment income with no receipts required. Federal Budget 2025. The average saving is about $205, Federal Budget 2025. But here's the part nobody tells you. It's not a bonus you bolt on top of everything else. It replaces itemizing. Treat it as extra and you've just overclaimed. 3 moves. 1. Pick a single, working from home method and stop double dipping. 2. Do the maths on the $1,000 versus itemizing. 3. Keep records that survive an audit. So how does the double dipping actually happen? The ATO's fixed rate method lets you claim 70 cents for every hour you work from home in 2024-25 and 2025-26 ATO fixed rate method. But that 70 cents already bundles in your additional running costs, electricity, gas, phone, internet, and stationery like printer ink and paper, ATO fixed rate method. So when people claim the 70 cent rate and then also claim those same bills again as actual costs, the ATO calls it double dipping. Full stop. Those expenses are already in the rate. Here's what that looks like in dollars. Say you work 800 hours from home. The fixed rate gives you 800 times 70 cents, $560, ATO fixed rate method. If you then also claim $600 of electricity, internet and phone as actual costs, you've claimed $1,160, but $600 of that is double dipped. At a marginal rate of 34.5%, that's about $207 of underpaid tax in a single year. And the ATO can amend your assessment for at least 2 years, authors estimate ATO rates. Now the second problem, and it's the opposite trap. The record rules have tightened. The ATO no longer accepts a 4-week representative diary. You must keep an ongoing exact record of every hour worked from home for the whole year, plus 1 bill per running cost category, and receipts for assets over $300, ATO fixed rate method. So when the easy $1,000 arrives, lots of people with messy records will just take the flat amount and quietly forfeit legitimate deductions they were entitled to. There are 2 ways to get this wrong, and both cost you. Overclaimers take the $1,000 and also itemize their working from home costs, overclaiming by hundreds and exposing themselves to back tax and interest, tax serve 2026. Underclaimers take the easy $1,000 when their real deductions are higher. Picture a heavy work from home professional with $1,470 of genuine expenses. Taking the flat $1,000 leaves $470 on the table, about $162 of extra tax every year. Authors estimate ATO rates. Here's the myth that catches everyone. People hear they can get $1,000 with no receipts and assume it stacks on top of their working from home claim. Wrong. It's either or. You take the standard $1,000 deduction or you itemize your work expenses, not both. Yahoo Finance 2025. Claim both, and that's double dipping. Compare the 2 totals and claim whichever is bigger. Put it together. Stack the $1,000 on top of your itemized costs, and the ATO could disallow over $1,200, about $424 of extra tax in 1 year. Authors estimate ATO rates. Or play it lazy and take the flat $1,000 when your real costs are higher, and you bleed roughly $3,200 over 20 years, authors estimate. Combined, the wrong call can cost $6,000 to $7,000 across a career. Meet Kate. She's 38, a marketing manager who works from home 3 days a week. She earns $110,000, so her marginal rate, including Medicare levy, is about 34.5%. She's an employee, no business, employer laptop. But she bought her own chair and monitor, and she averages around 900 hours of work from home a year. Here's what Kate found. Discovery 1, $173 a year. That's what Kate's been quietly underpaying. She's been claiming the 70-cent fixed rate and also claiming $500 of electricity, internet and phone as actual costs, ATO fixed rate method. But those bills are already inside the fixed rate. On 900 hours, her deduction should be $630. Full stop. The extra $500 is double dipped, and over 3 years that's roughly $1,500 of deductions she may have to reverse, authors estimate. Discovery 2. In 2026-27, Kate hears she can get $1,000 with no receipts and assumes she can add it on top. So she plans to claim the $1,000 plus $630 of fixed rate hours plus $600 in subscriptions and training. Gives $2,230 all up. But you can't claim the $1,000 and itemize the same categories again. Yahoo Finance 2025. If the ATO recalculates to just the $1,000, that's about $424 of extra tax plus interest. Authors estimate ATO rates. Discovery 3. And this one's the surprise. With proper records, Kate is actually better off not taking the shortcut. Her real expenses, $630 of fixed rate hours, $400 in subscriptions, $200 in training, plus a depreciated chair and monitor worth $120 each per year at $1,470 total. ATO fixed rate method. Take the lazy $1,000 instead, and she forfeits $470, about $162 of tax every single year. Authors estimate ATO rates. Add it all up across Kate's career, the clawback and interest from years of double dipping comes to around $850. Then 20 years of taking the easy $1,000 instead of itemizing, roughly $3,200. With pay rises and more equipment, the realistic lifetime cost pushes into the $6,000 to $7,000 range. Authors estimate. Could this be you? 3 signs. 1. You claim the 70-cent rate and separately claim electricity, internet or phone. 2. You think the new $1,000 is a bonus you add on top of your working from home claim. 3. You don't keep an exact year-round log of your hours. If any of those ring true, the next 3 moves are for you. 3 moves. Let's do them. Pick one method, run the maths, and lock in audit-proof records. Move 1. Pick one working from home method and stop double dipping. Go to the ATO's fixed rate method page and read exactly what the 70 cents already covers. Electricity, gas, phone, internet, and stationery. ATO fixed rate method. Then look at your return and strip out any of those bills you've also claimed separately. This is general information, not personal advice. 3 steps. Read the 70-cent inclusions list on the ATO page. Cross-check your last and draft returns for any duplicated bills. Then remove the duplicates. Keep either the fixed rate or actual costs, never both. Good looks like one clean working from home calculation with 0 double-counted running costs. Move 2. Do the maths on the $1,000 versus itemizing. Total up your real deductions, your fixed rate hours, professional subscriptions, training, and the decline in value of any assets over $300. ATO fixed rate method. If that total beats $1,000, itemize. If it doesn't, take the flat $1,000. The one thing you never do is claim both. 3 steps. Add your work from home hours times 70 cents to your other work expenses. Add depreciation on any assets over $300. Then compare your total against the flat $1,000 and claim the higher number. Good looks like claiming the larger of the two, never stacking them. Move 3. Keep records that survive an audit. The ATO no longer accepts a 4-week sample diary. You need an ongoing log of every hour worked from home for the whole year, one bill for each running cost category, and receipts for any asset over $300 with the decline in value worked out. ATO fixed rate method. Get this right and going over $1,000 is no problem. 3 steps. Log every work from home hour across the entire year, not a 4-week sample. Keep one bill per category: power, phone, internet, stationery. And file receipts for any asset over $300 with its depreciation calculation. Good looks like a year-round log plus one bill per category, ready to show on request. Why does this matter now? Back in 2023, the ATO killed the 4-week sample diary. You now need full year hour records, ATO fixed rate method. In 2024, it set the 70-cent fixed rate, which applies for both 2024-25 and 2025-26 ATO fixed rate method. And from the 1st of July 2026, the new $1,000 instant deduction goes live. No receipts, but you cannot stack it with itemizing Federal Budget 2025. The trap arrives next financial year, so get your method and records sorted before you lodge. After you've acted, check 3 things. You should see 1, working from home method in your return, not 2 overlapping claims. Confirm your claim total equals either your itemised maths or the flat 1,000, not both added together. And if you went above 1,000, make sure you've got the logs and bills to back every dollar. Questions? Talk to a registered tax agent. Everything here comes from the ATO, the Federal Budget Fact Sheet, and Tax Professional Guidance, all linked below so you can check it yourself. So now you know how the new $1,000 deduction can trigger an audit and how to claim it safely. Next, we dig into the depreciation deductions most work-from-home workers never claim. If this saved you from a costly mistake, subscribe. We read the fine print so you don't have to.